Hey, you may have wondered how the stock market works. You may have actually been thinking to yourself, how does the stock market actually work on a day-to-day basis? And what is a stock? So today I'm just going to give you a little bit of insight for those. I know there's so many of you out there that watch my channel for the day trading and the chart. I just thought I'd put it out there today on how the stock market works because it's important to a lot of people that just don't know, and it may be of some interest to them. In this video, I may throw in a little bit of charting on the chart patterns because we want to talk about that, and later in the week I am going to bring out a charting video which basically just shows you how to read the patterns. I had a few questions on patterns, and charting patterns can be quite important to your trading as well. But what is a stock and what's it all about? Firstly, let's talk about what a stock is. Basically what it is at the end of the day, it's a company, and that company is literally listing itself publicly to raise funds for its future business, let's say. Now, they list it on the public in the public domain so that you can now invest and buy shares in that company. Now, there are private shares with the CEOs have, and then there's the public shares which they put out to the market, which you can buy. What is that? That means for every one share, you own a portion of that company. So it's like starting your own business and you're sharing it 50-50 with someone else. You own 50% of the shares of that company. It's the same thing. So if you go out and you buy a share in Apple or Nvidia or a bank or JP Morgan or something to that effect, BlackRock, whatever the case, Warren Buffett's companies, you own a percentage of their company, and the price is broken up into the number of shares that are available on the market. The important thing to remember when you're investing in a stock is that most of these companies will give you a bit of profit sharing every year, in fact every quarter, and this is known as a dividend. During the course of the year, dividends will be paid out, and if you pick the right companies and you pick the good ones, then you'll actually get a decent return, 6 to 8%, sometimes even 10% on your money, but your investment still stays in place. In other words, if you own 10 shares of any particular company and those 10 shares are worth $10,000, the value of the company goes up to $11,000 through the year. It stays at $11,000, and let's say they decide to pay out profit sharing and the share value stays at that $11,000, you still get paid your share of the profit sharing, whatever that might be. If it gets paid out quarterly, it'll be the 6% over the year or 8% over the year divided into that quarter, and you'll get paid out that amount, say, on that period. And then, for example, in future periods, they'll pay out different amounts. They'll normally calculate how that particular section of the year went for them, how their profits went, and what they project for the future. So the value of a share is really calculated on its future earnings, not on what it's worth at the moment, because every company has an exact value for what it's worth today. But people buy shares based on what they think it's going to be worth tomorrow. We calculate the share value based on its earnings, based what we expect it to be valued at in the next year's time, which brings up what you got to look for. So one of the most important factors to look for is effectively the price to earnings ratio. If you want to know a little bit more about the price to earnings ratio, I'm sure you can search the internet and find a whole lot about it, but I'm not going to talk about it in this video because it's going to take too long for me to explain it to you. Perhaps I'll make another video regarding the price to earnings ratio, which will explain to you what that's all about. But just remember, when you're trading in investing and you're looking at things like price to earnings ratio, dividends, and that sort of thing, this is very much a fundamental thing. When you invest in a stock, you don't look at charts, you can, but it's not what it's all about. You don't buy and sell every week. When you're investing in a company, you literally want to keep that share basically forever. Because if you invest now and you put a couple $100 in every month, within 10 years, it's going to be worth an absolute fortune. So when you're investing in a company, you don't worry too much about whether it goes up or whether it goes down. You simply invest in it with a view to it improving its value over time. But what you do want to look for is good companies, and the price to earnings ratio will tell you, we call it the PE ratio, will tell you what the value, the price is to the earnings on the company, and if it's a good value to buy. Because you don't want to buy the company when it's really too expensive, because you might just be paying too much for something and it might lose value and never regain it. So you want to buy it at a reasonably average price to earnings or a cheap price to earnings, obviously the better amount. Be careful of that though, because if you do find a cheap price to earnings ratio on the company, it might be because something's wrong with the company as well. So have a look at the fundamentals, have a look at what's going on behind the scenes with that particular company. There are a few companies out there that are extremely good, that are on a high price to earnings ratio and maybe still worth the buy, because when it recalculates its new value in the future, you might actually find that the PE ratio has come into place because the value of the company has actually grown. That's all about future earnings, and it's all about looking at the actual value of the company. The next question you got to ask yourself is, why does the price go up and down if the company has a particular value? And as I said in the beginning, one of the big things you got to understand, buyers look at what the future value of the company is going to be when they purchase into the company. But that's it. The main reason the price goes up and down is because you have a willing buyer and a willing seller in the market. Just like with day trading, just like with any other trading, there's someone who's going to sell and there's someone that's going to buy. And with that, the supply and demand comes into play. The more shares in demand and the more people want to buy it, but the people don't want to sell it, the higher the price is going to go, because they're going to demand more money for the share because you really want to buy it. And the more a company wants to sell, or the more people want to sell the shares because they're really expensive and they don't want them anymore, they're taking profit, whatever the case, and they feel the company should be worth less, the cheaper the price becomes, and the buyers start coming in and buying when the price is at a better level. So that's why the price will fluctuate on a regular basis. It becomes expensive, it becomes cheap, it becomes expensive, it becomes cheap. It's as simple as that. Guys, while you're here, go and get your free Forex book down in the description. I've got it there for you. And also while you're there, go and visit our secret blog where I post a trade every single day. Not an investment, a trade. Very much a day trade. And you can go and you can grab the trade and you can enjoy it for yourself. It's just there for information. It's not trading advice, and it helps you get along at the end of the day. But don't forget, guys, drop down to the description. It's also in the blog. Get your free Forex book. It's there for you. Big thing is, guys, how do you invest? How do you invest in the stock market? How do you get your hard-earned money into these stocks? And where do you do this? Well, effectively what most people do is they look for a good broker that's out there in their country. Depends what country you're in. It's very important. Somebody asked me what platform I use, what brokers you use, and that sort of thing. And it's very relevant to the country that you're in. For example, I'm in Africa, South Africa, and I can invest straight onto the JSE if I want to, and that's the Johannesburg Stock Exchange. But if I want to invest in, say, the Dow Jones or the S&P 500 and that sort of thing, I've got to do it through an overseas broker. I can't just go and invest on that. So what you got to do is look for brokers that deal internationally, and normally there are many around, and a lot of the banks actually offer those services where you can invest in the stock market and they have a connection for you as a broker to invest in your own shares on the stock market. Those shares will have fees and costs and things like that, and the best thing to do is to look out for who's giving you the best fees, who's giving you the best costs, and that sort of thing for every trade you take. What your spreads are like when you're trading is a very important thing. So when you're investing, what your fees are percentage-wise for a trade or cost, and are they actually charging you for the account every single month? Guys, here's just a quick thing on trading patterns, what trading patterns can do for you, and then we'll go into more detail in a future video. Do yourself a favor and screenshot the patterns so that you can get an idea of these patterns are about. I've also included a little bit about candles. The engulfing candle is quite important, whether it's negative or positive or bullish or bearish, it doesn't matter. Keep an eye on these sort of things, you can see them clearly. This is my favorite pattern, the old head and shoulders. The head and shoulders, when it plays out, it'll go the same length as the neck here down to the bottom. The double top, really important. You can see when you get two top ones here, it goes through the neckline. This is the opposite version, the bottom, double bottom, and once it breaks through, which is basically your support and resistance, it goes through and it goes in that direction. Screenshot these guys. These are candles, which way they go, the three soldiers, the three crows, the engulfings, the shooting stars. This is support and resistance, the resistance line and a bit of a ascending triangle, and you can see it breaks out. These are the cup and handles. The cup and handles also, you get the big cup and then the little handle, and then off she goes and it carries on going. Identify these patterns and see these patterns in the market. Quite important. Screenshot this, guys, study it, have a look at it, all the different little candle patterns that you might see in the market. As I always say, just watch them. The doji is important, guys. The gravestone doji as well. Super important. So, there you go. So that's just a quick one on the trading patterns and what the trading patterns can do for you. Guys, if you want to know more about investing, it's very important to manage your risk. Risk is so important. You've got to manage that risk and look after that risk when you're trading. If you want to know more about risk management, watch my previous videos and see what risk management's all about. Guys, thanks for watching. Till the next video, cheers and bye.